Hi, everyone. Welcome to this week's market update. I'm here with Eric Anderson. Eric, let's start with the big picture. It feels like we're ending the week with tech still in the driver's seat, but a lot of uncertainty around everything else. What stood out most to you?
That's exactly it. Tech is still the star of the show. Even with the US government in shutdown mode and with the usual economic data releases missing, investors are still piling into technology. The Nasdaq continues to outpace the S&P 500, and what's striking is how this momentum isn't just an American story anymore. This week, Japan's tech giants jumped into the spotlight. Hitachi announced a collaboration with OpenAI, and Fujitsu unveiled a partnership with NVIDIA. These aren't small deals. They show that the AI and digital infrastructure race is now cross-border, and it's shaping global capital flows in real time. The narrative is no longer just US big tech. It's becoming a multi-continent competition to own the future of computing.
So the US is exporting the AI narrative, and Japan is picking it up. But on the policy side, Japan has its own story, the rate hike question. Where do things stand there?
Yes, Japan is fascinating right now. The Bank of Japan has been dangling the prospect of policy normalization for months. Governor Ueda gave a cautious update this week, basically saying inflation is near target, but wage growth is still fragile, and global uncertainties make the outlook tricky. Translation: the BOJ is in no rush. October could have been a turning point, but they're keeping markets guessing, and that keeps the yen stuck in a tight range. Investors are desperate for clarity, but the BOJ's balancing act is deliberate. They want to avoid shocking fragile consumer sentiment while still signaling they're not asleep at the wheel.
Let's pivot back to the US for a moment. Beyond tech, what are markets watching in terms of risks?
The shutdown is front and center, and there are really three scenarios playing out in investors' minds. Scenario A: a short-term resolution, maybe a week or two. If that happens, markets will probably shrug it off. Risk assets rebound, confidence resets, and it's back to business as usual. Scenario B: a prolonged shutdown, 3 or 4 weeks. That's where economists say you start losing about $15 billion of GDP per week. That's not trivial. It could pressure the Fed to cut faster, especially because missing data makes policymaking more of a blindfolded game. Scenario C: the long game. President Trump has already hinted at using this moment to push through rescissions, reshaping fiscal priorities, and even threatening layoffs. Shutdowns don't formally expand presidential powers, but they tilt discretion toward the executive, and that's where markets get uneasy. The real issue is visibility. Without government data, payrolls, CPI, all the usual markers, markets are flying on private sector surveys like ISM, and those are telling us manufacturing is still weak, still in contraction, with only a small bounce in production. So there's not much reassurance there.
Interesting. Let's talk about IPOs. There's been a lot of chatter that they're making a comeback.
Yes, and this is one of my favorite stories of the week. Bloomberg pointed out that 2025 IPOs are averaging a 28% gain on day one. That's the strongest since the 2020 frenzy, even stronger than 2021 when equities peaked before the bear market. That tells you something important. Fear of missing out is back. When the IPO market runs hot, it means investors are hungry for growth stories. They're willing to take risk. They don't want to be left behind. It's another sign that despite all the macro uncertainty, equity appetite is alive and well.
And outside the US and Japan, what else caught your attention globally this week?
Australia deserves a mention. Its fiscal discipline is paying off. The budget deficit came in 21% narrower than expected, just 0.4% of GDP. That's a big contrast to the US and Europe. The Aussie yield curve is remarkably flat, and with a 10-year yield at 4.33%, compared to 4.09% in the US, it could start attracting foreign demand. It's a reminder that in a world of fiscal stress, countries that manage their books prudently stand out, and that has real investment implications, from bonds to currency.
That's it for this week. Stay tuned for more insights next time.